Welcome everyone. This is session number 10 of our March ISA event. Today we have Bradley Biggins, manager of Schroder Real Estate. I think it's probably fair to say that the recovery of UK commercial property over the last couple of years has been quite stealthy. But if you pull up a share price chart of Schroder Real Estate and many other REITs, you'll see that actually performance has been very strong following the interest rate cyclical downturn that started in 2022. So there's quite a lot to talk about beyond just discovering why the asset class might recover. We're back into the territory where fundamentals really matter, and Bradley has a fairly unique strategy in the UK REIT space that sustainability is built in to the mandate. I think he's going to show you that sustainability is really crucial to all UK commercial real estate. He's going to talk for about 25 minutes, and then there's an opportunity for questions after that. For those of you who've been to one of these before, you know the drill. There's a Q&A box in the bottom right hand corner. Please do type your questions in that during the presentation. I'll be reading those whilst Bradley's speaking. And should you have any technical problems, you can also type something in the box. One of my colleagues will try and help you. And don't be shy. No one else apart from me can see your questions. I'll try to get through them all, but if I can't, then we can always try to get you an answer later on. And this presentation, as for all of them, is recorded. So there's a chance to watch it again and download the slides. And with that, I'll hand over to Bradley.
Thanks very much, Alan. It's great to be here, and thanks everyone for your time on such a lovely day. I'm going to be talking about Schroder's Real Estate Investment Trust Limited. Now, if there's one slide you take away with you today about SREIT, it's this one. So this is our investment case summary for SREIT. Now, today we're delivering a more than 7% dividend yield, which we think is very attractive. And we're also committed to delivering a progressive dividend policy. So we only raise the dividend when we think we can maintain it. And we are also looking to raise the dividend as often as possible when we think it is sustainable. Now, how are we going to grow that dividend? Well, we have a very attractive income profile in our underlying real estate portfolio. It has a reversionary yield of 8.3%. Now, what that means is the independent valuer thinks there's an additional rent of £9 million available in the portfolio as you revert to market levels. Now, what does that mean? You know, £9 million. Well, in the context of our annualized dividend, which is £17.5 million, it's clearly material. So we only need to capture some of our reversion to have a good impact on the level of dividend. Now, of course, it's not all about income. All companies have costs, and we're delighted to say we've got a really strong balance sheet. So our balance sheet, we have an average interest cost of 3.4% on our debt, and that has an average maturity of 7.7 years. So a really strong balance sheet. And I think what you'll find if you look at some of our peers in the listed sector, they have near-term refinancings, and I think you'll find that their interest costs will increase, which will of course erode their earnings, but we're in a very strong position in that regard. Now, the share price has been actually very strong relative to most of our peers, but it's down about 10% since the Middle East conflict ensued, 3 weeks or so ago. And, that could be an attractive entry point, actually, considering, like I said, we've been trading at a sort of 10% discount, sometimes 9% over the last 12 to 18 months. So potentially attractive entry point, especially given the market recovery in real estate, which Alan had alluded to in the introduction, and which I'll speak to shortly as we look at the market context. Now, of course, macro largely outside of our control, but we do think there's earnings growth potential in this fund, and we will be focusing on our day-to-day there to drive rental growth and drive that earnings, which should help us increase that dividend. We have a very clear strategy. We focus on real estate fundamentals, but we also look through our investing and activity through the lens of sustainability, because we think that's crucial in real estate, which, remember, is a physical asset. There are regulatory requirements. It just can't be ignored. And we have really good examples that I'll talk you through as we flick through the presentation of where we're making excellent sort of headway with our rental growth and valuation increases as we execute the strategy. Now, the slide here, we're talking about what we've been up to in the last quarter. So this presentation is based on the quarter ended December 2025. Our financial year started in April, so we've already released our interim results for the 6 months ended September. We released those in November, and this presentation is really an update in the most recent quarter to December. Now, I'm pleased to say we've maintained excellent momentum with our leasing activity. So since the 27th of November, so around 3 months ago, we've completed 13 letting transactions, which is about one a week. And they total £1.8 million of rent. And encouragingly, our lease renewals and rent reviews, so where the tenant is staying in the same unit, the rents we've agreed are 21% higher than the previous passing rent. So we've still been able to grow rents. And I think that that will continue. And we'll talk to that shortly when we look at the market context. Our portfolio void rate has reduced to 9.7% as at the 27th of November. And that is a really good improvement on the 30th of September, where it was 12.2%. And that reflects some of that leasing activity we've been up to. Like I said, we're working really hard every day to try to grow that rent. 65% of our portfolio is allocated to what we consider to be higher growth sectors. So that's multi-let industrial and retail warehousing. We see really favourable supply demand dynamics in those sectors, and that's where we're experiencing the strongest rental growth. Now, our performance has been fantastic relative to peers and relative to our benchmark, and you don't have to take my word for it. We have, for the second consecutive year, been awarded the highest 10-year risk-adjusted relative return by MSCI for all UK and European funds. So there's more than 100 funds there. So that's fantastic to win a long-term award like that, and we're going to work to continue to maintain that performance. We all, at Schroders, we're also always focused on best-in-class governance. And at the beginning of the quarter, so effective the 1st of October, our management fee was amended to provide further alignment with shareholders. And there's also a slight saving for shareholders, because what we've done is we've linked 50% of the fee to the market capitalization of the fund, whereas previously it was fully linked to the NAV. And that's because we want to be more aligned with our shareholders. And I'm sure you'll get out the world's smallest violin with regards to our lower fee at the moment. Now, looking at the performance in the quarter from a NAV perspective, this is a fairly standard reconciliation showing how the NAV has moved for the quarter. Valuations increased. We did spend capex as we invested in our portfolio to enhance the sustainability performance of our assets, but also to make sure that we have the amenities in place to attract the best tenants on the best terms. We sold a couple of assets. We completed the sale of 2 assets in the quarter, and we made a gain on disposal on those assets. So they were sold 7% ahead of the book value at the beginning of the financial year. And that gives us confidence in our valuations that underpin the NAV. The final point I know on this slide is that the fixed rate loan that I'll talk to shortly, but it's the underpinning the strength of our balance sheet. So that fixed rate loan has a fair value of £17.7 million, and that is not reflected in this NAV. So that's upside to the NAV. Here we summarise our quarterly P&L down to EPRA earnings for the current quarter compared to the previous quarter. Some key points I'd flag here. So rents are up 2%, so rental and related income up 2% on the prior quarter. And that is reflecting some of our asset management activity through the financial year so far and in the last quarter. And what's encouraging is we have sold a number of assets through the period, but the rents we've been able to gain from our investment into the portfolio has been outpacing quarter on quarter the rent we've lost from disposals. As I said, we've got an attractive income profile. The portfolio net initial yield is 6%. That's well ahead of the benchmark at 5%, and is of course well ahead of the cost of our debt, which is 3.4%. So it is shows how accretive our debt is. I touched on the reversionary yield at the beginning, where we had that £9 million rental upside according to our independent valuer, and we are always looking to control costs. Now, that reduction in void that I mentioned before, down to 9.7%, that will support future earnings growth, because the majority of the activity to reduce that void actually hasn't, the upside from that isn't reflected in the P&L yet. So as we talk through the examples, I'll explain that further. Here we set out our balance sheet, just to show you how strong it is. We've got two facilities, a fully drawn fixed term loan from Canada Life, that's 129.6 million, and a RCF facility, which has a size of 75 million, but we've only drawn 54.5 million at the moment. Now, that fixed term Canada Life loan really underpins the strength of the balance sheet. It represents 70% of our drawn debt and has a fixed average interest cost of 2.5% and an average maturity of more than 10 years. So that provides excellent protection and excellent visibility on the costs in our earnings as we look forward. I've mentioned performance before. Here we set out performance, and you can see you're outperforming over 1, 3, and 5 years. We're an income-driven fund. Most investors own us for income, and over the long term, the majority of your real estate total return will come from that income return element. So we think we're right to focus on that part of the total return, and you'll see that we do outperform on an income return perspective over all 1, 3, and 5 year periods as well. Now onto the market. So the conflict in Iran and the Middle East, it does have the potential to negatively impact inflation, growth, and consequently the path of interest rates, both initially and on a subsequent, more meaningful second order basis. And what we're showing on this slide is really the impact of that conflict. So we're showing how the market expectations for the path of interest rates have changed over the last sort of 2 weeks or so. So we've gone from the market expecting 2 rate cuts down to 3.25% in the current calendar year, and that you can see on the left-hand side, to the market expecting no rate cuts at all, and actually a meaningful probability of rate increases. Now, the situation, of course, remains fluid, and the extent of the impact will be dependent on the duration and intensity of the conflict. So it really is one that we're monitoring. Now, what I would say is there is a contrast to the situation that we experienced back when Ukraine was invaded in 2022, after which we saw double-digit inflation. So we do think there are some contrasts to that. So, for example, in that 2022 period, not only was there that invasion of Ukraine, but we were coming out of the pandemic period, and there were still pandemic-related supply bottlenecks, which we don't have sort of on a global basis as a result of this conflict. In addition, in 2022, we were easing pandemic restrictions, and that led to a rapid recovery in demand from households. And remember, household incomes were maintained through the lockdown, so they had savings to spend. Current labour market conditions, whilst robust, they are softening, whereas what we saw back in 2022 was a wage price spiral, and that was a key contributor to inflation as we came out of those pandemic restrictions. So there are a number of reasons as to why the situation isn't as stark in terms of inflation as it was back in 2022. But of course, higher oil, higher energy prices will have an effect. And you can see that on this slide here as an example, showing the expected path of interest rates. Now, despite all that uncertainty, and this time from the Middle East, last time I was presenting sort of for our results was the interims. We had the uncertainty around the UK budget. Well, the uncertainty this time is around the Middle East. There are supportive real estate market fundamentals, and I'll talk you through that now briefly. So if you touch on the top left-hand slide chart, you can see that from June 22, which was a cycle peak, we saw a 25% reduction in the average value of UK real estate. Now our portfolio performed much better, but on average, the average value of your UK real estate declined by 25%. Now, since that decline, there's only been a modest recovery in capital values, depending on what index you look at, it's probably around 3%. So there's still a long way to go before we get back to the previous levels. And what's been really interesting about this cycle, which is in stark contrast to previous cycles, is that despite this 25% reduction in capital values, rents have continued to grow throughout the period, particularly in structurally supported sectors like industrial. And that's what we're showing in the chart on the top right-hand corner. So the green line represents industrial rental growth since the cycle high in June 22, and you can see rents are up nearly 25% on a nominal basis. And that is very different from the experience coming out of the GFC, for example, which is the red line. Now, what that means is, values down, rents continue to grow, is that there's an attractive income return from real estate available at the moment. And that's reflected in the very attractive income profile of our portfolio, which I spoke about, where we have those very high yields. And that drives that dividend yield. Now, we think that rental growth is going to continue. And a couple of reasons I'd just like to touch on as to why. So first of all, construction costs. Construction cost inflation has been very high, particularly in the last 4 years. And what that has resulted in is a very thin pipeline of new developments. So there's less supply coming through. In addition, what it means is where construction or major refurbishments are undertaken, the landlord has to charge higher rents than what are currently passing in the market. And that puts upward pressure on the rents on existing space. And the second point I'd highlight is there's a real sort of lack of supply of high quality, high ESG spec space. And the chart in the bottom right hand corner shows you the situation for offices in some major locations, such as central London and some of the big 6 cities. And the red bars indicate the vacancy rate for grade A office space, which we've used to sort of represent that higher quality space. And you can see it's, around 2 to 3% for Leeds, Edinburgh, Bristol, Birmingham, for example. So if you do have good quality space, you should be able to put, good pressure on tenants to pay a higher rent. So you can see the real estate fundamentals do continue to look quite attractive, particularly when it comes to rental growth. Now, touching on our strategy, so as Alan said, and as I've said, we do look at our real estate through the lens of sustainability, as well as the real estate fundamentals. I mentioned that we like the favourable supply-demand dynamics in multi-let industrial estates and retail warehouse, for example, which is where 65% of our portfolio is allocated. But to kind of give you a good example of a proof in concept of our strategy, we like to talk about Stanley Green Trading Estate, which is in Manchester. So here we acquired in December 2020 an estate. It had 14 older units on it already, plus a 3-acre development site. We spent the best part of 10 million developing that development site to create 11 EPCA plus BREEAM Excellent units. And what's been really interesting about those new units that do have those strong sustainability credentials is they are commanding much higher rents and much keener yields than the older units. So for example, for a similar size space, you're getting a 39% higher rent. And the yields on the new space are 5.25% equivalent yield. And that compares to 6.25% plus for the older units. So not only are you getting more rent, but you're getting more value per unit of rent. And we think a large element of this is green premium. And the final point I'd make on that is not only do you get higher rents, keener value, but you're getting much better tenants. So for example, we've attracted Siemens to the estate, and we've also attracted ABB, the Swiss-based global conglomerate, electrical engineering firm. And they are joining us not just on those higher rents and keen yields, but also, excellent terms in the lease, such as rent reviews linked to inflation, long terms, etc. So it's a really compelling case study. And the question is, well, you spent, best part of £10 million to develop those very high spec units, and you're getting higher rents. That's great, but has it been profitable? And we think emphatically yes, and that's what the total returns show. So for this asset, we've achieved 15% per annum since acquisition. So that's a number of years now. And that compares to the MSCI All Industrial over the same period of 8%. So we've outperformed by 7% per annum over about 5 years. So really fantastic example of the strategy in action. Final point I'd make is I mentioned those 14 older units, and what we've been doing is undertaking rolling refurbishments of those units, and we've been able to benefit from that higher rental tone that's been set on the new element of the estate. So, for example, we've recently agreed a 54% uplift in rent for Screwfix, who occupy on the existing estate, and that follows a refurbishment that we undertook for them. So there's more upside to come. I mentioned at the start, we've made really strong progress through the quarter and post-period end with regard to our leasing. So we did 7 new lettings. They total 1 million of the 1.8 million, and encouragingly, they're 0.3% higher than our December ERV. And that's important because I mentioned that reversionary yield before, which is based on the ERV. And people often question me and say, you know, that's fantastic. It's a very high and attractive yield, but is it achievable? Well, what these lettings show is, you know, not only are we achieving it, but we're achieving it right now. And I mentioned before, our rent reviews and renewals are 22% and 21% ahead of the previous passing rent as well. We've been disposing of assets in the quarter and post-quarter end. And as I mentioned, the 2 we disposed of in the quarter were ahead of book value. The one we disposed of post-quarter end was a bit below book value, but we think that's the best thing to do for the fund. And we've been continuing to control costs, particularly with that management fee change. Now, I'll briefly touch on some examples of where we're executing the strategy in the portfolio. And as I said, we really are focusing on the day-to-day of our job, despite the wider uncertainty in the world. So if we start with St Anne's House in Manchester, we've almost completed a £3 million refurbishment of the asset. We're undertaking a refurbishment of the basement, the ground floor, where we're installing a sort of institutional grade reception. We're adding meeting rooms, wellness room, a yoga studio, end of journey facilities for cycle storage and showers, a podcast studio even. And we're also undertaking a Cat A refurbishment of the 5th floor, which is a top floor office space. And what that refurbishment has enabled us to do is quote a much higher rent on that 5th floor. So we're now quoting £28 per square foot, which is 74% higher than the previous passing level on that floor. And actually, I think we're going to exceed that £28. Now, of course, we're spending a lot of money to do that. And what we're aiming to do is increase the passing rent at the asset from 0.9 million today to 1.5 million in 4 years' time. And that would achieve an IRR over the period of 13% per annum. So it is accretive. On the right-hand side, we're showing Millshaw Park Industrial Estate in Leeds. This is our second largest asset by value. Brief background on the asset. It's been a really strong performance since we acquired it in 2015. So just like Stanley Green, excellent performance. This asset's achieved 12.2% per annum over 10 years, and that compares to 9.6% for the MSCI All Industrial. It's a huge estate, 460,000 square feet across 28 acres. It's located just south of Leeds city centre and is close to the M62 motorway. Interestingly about Leeds, the vacancy rate for industrial is very low. It's much lower than the national average. So roughly 3% in Leeds, 5% national average, or 5.5% national average. So that's enabled us to drive rents on. But we recently got a large unit back. So it's 50,000 square feet, which is around 10% of the estate. And we undertook a 1.9 million refurbishment to move that EPC on to an A. It was previously a C. And as a result, we've exchanged an agreement for lease with Slazenger Paddle Club, which is a part of the Sports Direct and Fraser's brand. And that rent we've achieved is 86% higher than the rent we were getting in June, which is when the unit became vacant. So again, very accretive. And in fact, we were expecting to make profit on this unit of 1.1 to 1.5 million pounds overall as part of the project. So another really good example of the strategy in action. On the left-hand side here, I'll just briefly touch on Headley Central in Leeds. So this is a mixed-use, 110,000 square feet, prominently located town centre scheme. It's anchored by tenants such as Premier Inn, Sainsbury's and the Gym Group. And actually, we've got 2 new exciting tenants joining the scheme now. A couple of years ago, you might remember Wilkinson's went bust. We had Wilkinson's on the scheme here. Got the unit back, divided it in two. We've let half to McDonald's and half to Tesco, so fantastic result. And interestingly, the McDonald's lease is a 25-year term with a break at year 15 at a rent of 75k per annum, which is a 28% increase versus what Wilco's were paying. And the other half is we've exchanged an agreement for lease with McDonald's, and their rent is 93% higher than what Wilkinson's were paying. And again, it's a 15-year term certain. So got much better tenants, much longer leases, inflation-linked rent reviews, and a much higher rent. So a great result. And then the final example I'd like to touch on is Churchill Way West in Salisbury. This is one of our retail warehouse schemes. I mentioned we really like retail warehouses, and we've made fantastic progress on this asset over the last couple of years. So just some background. We own 3 units on the estate, and they're next to a very large Waitrose. So, excellent place to be. There's lots of parking. Now, the previous tenants were Smith's Toys, HomeSense, and Sports Direct. We re-geared Sports Direct, and they're staying, so they're Unit 3. We ran the leases of Smith's Toys and HomeSense down to expiry, and we were able to instigate a bidding war for Lidl and Aldi to take part of the space. And as a result, Lidl won the bid. They came up with the best bid, and we've let the enlarged Unit 1 to them for 25 years with a break at year 20 with inflation-linked rent reviews at a rent of 440k per annum, which is £19.81 per square foot. So a really healthy rent for a retail warehouse scheme. And that rent is 67% higher than the previous passing level. So we didn't just get that, we had to spend £1.5 million to enhance the unit, to reconfigure them, to create a larger Unit 1 and a smaller Unit 2. But it's been a fantastic result to get such a strong tenant on the scheme on great terms in a better unit. And the EPC of Unit 1 is now A+, and it was previously a D. So great work there too. And I'm happy to report we've now exchanged an agreement for lease on that Unit 2, which was previously a HomeSense, with the Gym Group, and they have taken a 15-year term without breaks at a rent that is also 67% higher than the previous passing level. So a really good result there. Now, finally, just to give you some colour on how we're looking to achieve our reversionary rent. So on the left-hand side, you can see our current passing rent, which is 30.4 million per annum. That reflects a net initial yield of 6%. And on the right-hand side, the blue bar represents our reversionary rent, which is provided to us by the independent valuer, and that's £39.6 million, and that reflects a reversionary yield of 8.3%. Now, how can we get there? We've shown some illustrative steps here. So we've got 3 million of fixed uplifts in our leases today, and they're in the next 12 months. We've exchanged agreement for leases totaling £900,000. So that includes the Slazenger Paddle Club's lease I mentioned earlier. It includes the Tesco's as well, for example, and it includes the Gym Group. So when those leases complete, which are usually subject to landlord works and or planning, we'll start to be able to recognise rents in our P&L for that. So the majority of those examples I just spoke through, in fact, all of those examples, we don't yet have the upside in our P&L from those new deals. So that's upside to come. There are certain units in our portfolio where the ERV is higher than the current passing level. So as rent reviews and renewals come around, we'd expect to move the rents on to those higher levels. And as I touched on, we're clearly achieving that with our 21% increases that I've reported on earlier. And finally, we still have some vacant space. So there's £3.8 million of vacant space that we're working hard to let. And we think our run rate vacancy will be in the 8 to 9% range. We're currently at 9.7%. So the point is we'll never have all of our space let, and that's a function of our strategy and our assets. But the high yield that we achieve, we think is attractive enough to offset that. Now, just to reiterate that the difference between our passing rent today and that reversionary rent is £9 million, and our annualised dividend is 17.5. So if we can achieve that uplift, we should be able to have a good impact on that dividend. Now, just some closing comments. As I've said, the conflict in the Middle East does have the potential to negatively impact inflation in particular, which could mean interest rates stay higher for longer or even increase. and that could impact that nascent recovery in UK real estate activity and values. But we should remember that the environment in the UK does remain supportive, with regards to that limited development and the positive rental value growth we expect. And also, occupier fundamentals have been remaining resilient, particularly in our portfolio. Our investment performance has been very strong versus peers, and we have won awards that sort of speak to that. And overall, we think there's a significant opportunity to accelerate our earnings growth as we capture that very attractive reversion with our active approach to asset management. And with that, I'll pause and look forward to any questions that you might have.
Thanks, Bradley. And I'm going to start by touching on the Middle East
Yep.
thing, but not to get any predictions. I think one of the lessons from history it might be worth reflecting on is we obviously, whilst it was a very, as you touched on, it was a very different situation in 2022, but energy prices went up.
Yep.
And I wonder if you have any learnings from how that affected tenants. And I suppose the second part of my question perhaps answers itself, but it might give you a chance to expand a bit on some of the sustainability capex. Obviously, one of the big things that you can do is install renewable energy on an asset, and one would assume that higher energy prices might make those buildings even more attractive. Can you kind of expand on the extent to which you install that kind of kit and what you expect from higher energy prices?
Yeah, absolutely. So I think in terms of energy costs, as a landlord, we incur energy costs for some of the common areas and shared space, and we locked in our energy supply in September for at least a year. So we're not going to be affected until September this year at the earliest, which is obviously helpful from a landlord perspective. And in terms of tenants, I mean, look, higher energy prices aren't good for any tenant. I think sectors that will be hit the hardest will be data centers, very energy hungry, heavy industrial, which we don't have that much of. But there's no surprises there really. But to your point around what we're trying to do with the strategy is we are absolutely trying to provide space to tenants that is energy efficient. Where possible, we're installing PVs. So some of the examples I spoke through, so for example, Slazenger Paddle Clubs, they've got PVs. The Lidl has PVs. At St Anne's House, we put PVs on. So 3 of the 4 examples have got PVs. So, that should help the tenant. I think there's only so far you can go with the real estate. So, such a vast proportion of the energy used by some of these businesses isn't from the actual real estate. It's from the logistics business. It's from moving their stock around. For retail, it's similar. So there's only so much we can do. But I think it does reaffirm the strategy. I think it does show that as a country we need to have a more distributed and diverse energy mix, and we should continue hard on renewables. And in my opinion, the small module nuclear reactors as well, to really diversify that mix and not be dependent on these choke points.
Yeah, and at the beginning you mentioned, of course, that in the last few days the share price has come down,
Yep.
and mindful of people on the call who may be looking at this with interest for the first time. Some of the labels in commercial real estate are quite generic, aren't they? And I think real estate is one of those asset classes where everyone has an opinion because we encounter it in our daily lives, but there's a perception, maybe there's a perception versus a reality. And so do you want to just talk a little bit? I mean, you've mentioned a number of tenants, and if you wrote them all down, you could already see that I think almost all those tenants were industrial inverted commas, tenants, that hints at the fact that that label encompasses a really broad suite of different activities. Do you want to just give us a flavour for how much diversification you can get within what seems to be a very straightforward label?
Yeah, it's a great question. And look, our industrial portfolio is very much focused. It's almost entirely multi-let industrial estates. And that's very deliberate. And we think the supply demand dynamics for multi-let industrial estates are very attractive. And that's in contrast to what you might call big boxes, where you've definitely seen a softening of demand and a softening of rental growth. And the great thing about these multi-let industrial estates is they're so versatile and they attract such a broad range of the UK economy. So you could have manufacturing, assembly, self-storage, gyms, paddle. We've got trade counter, um, you know, just a broad range of users. And I think that's fantastic. And it really opens up your, your assets to a wider market. And the other great thing about multi-let industrial estates is over the last 15 years, barely anyone's been building them. And where you've seen development in industrial, it's largely been the big boxes. And you see that the evidence of that is clear when you drive up and down the M1 in particular. You see those giant boxes. And there are a number of reasons for that. One of them is typically for a developer, when they're building a big box, they can pre-let the asset. Certainly in the past, they could pre-let it to an Amazon or a DPD. So it really de-risks the development for them. They effectively know, what they're going to get. Whereas multi-let is very different. You generally have to build the asset and then let it up after it's finished. So you're taking on what you call spec risks. You're speculatively developing these assets. And we've done that. We did it at Stanley Green to great success. And the reason we're able to achieve that is that we have a very deep team of sector specialists. So we've got industrial specialists, we've got retail specialists, hotel specialists, office, etc. And they're in the market all day, every day. And also at Schroder, we've got this massive real estate platform. It's not just SREIT. We've got this broad range of products that we're managing on a day-to-day basis that gives excellent market insight. So we can be fairly confident when we decide to develop a new scheme somewhere as to, if it's going to be successful or not. And the final point I'd add is with SREIT, it's a very granular sort of tenant mix. So we've got more than 300 tenants, and that diversifies the risk across a large base of tenants. And that's, again, a function of the multi-industrial estates, where you might have 60 different tenants on one estate, which we have at Stacey Bushes, our largest asset by value in Milton Keynes. So, yeah, I think really good question. I think it would be really good if investors could, take away that point around the multi-let differing from other types of industrial asset.
Yeah, and one of the other maybe perception versus reality points is the pandemic cast a long shadow on how we think about offices, and working practices have not gone back to what they were, but they haven't turned out to be quite as remote as some of the wilder predictions in 2020. So it's an asset class that I think a new investor would perceive as being difficult, and maybe the reality is a little bit different there as well. How do you feel about the office space at the moment?
Yeah, I think in offices there's a real spread of outcomes and there's going to be a real mix of performance, and it's going to be asset by asset specific. You're seeing this clear bifurcation in, if you've got a great office in a great central location with good ESG credentials, you're going to get a great tenant on a better lease, better terms, longer term, and you're going to do okay. But if you're left with offices that really are out of sort of fashion, they're not well located, they're old, dilapidated, they were historically serving sectors that are continuing to work from home a lot more, then you're going to struggle, and you're going to have to invest a lot of capex in your assets to keep them let. You're going to have a very short WALT, so you're only going to get short term certain with tenants, 2 years, for example, if you're lucky, and you're going to be running very hard just to sort of stand still. So I think the point around the office sector is you need to be very selective, and you need the right sort of teams and expertise to be able to help you to do that. So I wouldn't write off the sector entirely, but you just be very careful about which specific office assets you own.
And I also want to go back to something you mentioned early on in your presentation, and I think property fund managers sometimes a bit understated about this. But you mentioned your outperformance of the benchmark. Do you want to and over more than a decade, and you've been along for all of that, haven't you? The benchmark you're talking about isn't the same as an equity investor would think about, is it? You're actually beating your benchmark, you're beating your competitors, in simple terms. Do you want to talk a bit about how that benchmark is constructed, and then do you want to expand on why you think you've so consistently outperformed it?
Yeah, so the benchmark we're referring to talks to the portfolio itself. So it's purely looking at what you're doing with your real estate, and it's now run by MSCI. It used to historically be run by IPD, which was acquired by MSCI. And most funds will sort of subscribe to the benchmark. They'll submit their own data into the benchmark. MSCI will amalgamate it and then get back to you and sort of tell you how you're doing. So it's kind of helpful to be included, so you understand how you're performing relative to your peers. So it really is a benchmark of your peers. Many of the other listed funds will be in the same benchmark, and therefore you know that we are performing very well relative to those peers. I think there's lots of reasons for the sustained outperformance. I think a focus on income has been helpful. As I mentioned, we're all typically outperform on the income return element, and that's where the majority of your total return comes from in real estate over the long term. I think it's been careful sector allocation. So, for example, that increase in industrial, as you saw that really strong industrial trend over the last decade. But interestingly, if you look at our performance, you can break it down into different sort of parts, and we outperform on what's called selection. So that means our portfolio of industrial or our portfolio of offices outperform the wider office market or the wider industrial market. So they call it selection. And I think that comes from just having that broader real estate platform with sector specialists who are in the market, get the best data, understand, where the rents are in certain sectors and certain locations, and it just helps you make better decisions. And I also think just the intensity with which we manage the portfolio helps too. There'll probably be buy and hold investors in that benchmark who aren't day to day trying to move rents on, trying to come up with creative ways to improve assets and bring in better tenants and add value like we do on a day-to-day basis.
I think that was a very understated answer, Bradley. I'm not going to I don't think it would be fair to ask you some specifics about corporately about Schroder Real Estate. I think that's a question for the board, but there is a question that I suppose it hints at an interest in M&A in your specific peer group, but more widely in REITs in the UK. It's been quite a dizzying couple of years, hasn't it, for M&A? What are your thoughts on that?
Yeah, so for me, I think there's been some sort of structural factors at play. So historically, a kind of key shareholder in REITs would have been wealth managers, and wealth managers have been extremely successful in growing as businesses themselves, and it just means they have massive amounts of capital to move in and out of investments. And that has meant certain REITs have just become too small for them specifically to invest in. And as they've sold out of their positions, it's put downward pressure on the share price, which has enabled takeovers to ensue, whether that's private capital, coming in and taking out listed companies at a bargain price, or other bigger REITs sort of consolidating and being able to buy real estate at discounts. So I think that's been a key structural factor at play. I think conversely, and there are a broad range of other shareholders who still like REITs because they like that income return, they like that attractive dividend yield. They're not moving billions of capital in and out of funds. It's the liquidity is absolutely fine for them. And I think where SREIT has been successful, particularly in the last sort of 3 or 4 years, has been pivoting towards that new investor base and really communicating the benefits of SREIT to them, particularly that income yield and potential for that income growth. I think the performance has been strong as well, supporting that. So, I think sometimes people kind of say REITs are too small, companies are too small, and I think that's true, but only for specific investors. I think for the majority of other investors, the fund size is fine. I do think there's a scale benefit to being bigger, and we'd love to grow the fund. We're trying hard to do that. That's why, we had been delighted at the share price discount recovery. We're in single digits. It's a shame as to what's happened, but essentially completely out of our hands. But like I said, we're going to stick to the day job, keep growing rents, keep trying to perform, and hopefully, we get our opportunity in the future to grow.
Yeah, so as you say, share prices hopefully temporarily come down. The M&A means there's less supply, but you've got this contradiction, if you like, that throughout it all, rents have grown, and that's going to start feeding through to income and dividend growth. So this could well be a great entry point. I think we've ticked over our time now. My colleagues will be delighted that I've noticed that and haven't carried on. So Bradley, thank you so much. And thanks to everyone who's attended. As I said at the top, this is recorded. You can watch it again. You'll be able to download the slides. If you have any other questions, please do get in touch. And of course, Bradley and the team put a lot of effort into an informative website and annual report, which you should always read, and then you should come to the Kepler website afterwards for some follow-ups. Thanks to everyone, and thanks to Bradley.
Thanks, Alan.